Hey everyone, me Kevin here. So obviously inflation is like all the rage to talk about right now. Everybody is talking about inflation, and in this video, I want to look at something very particular when it comes to inflation. What spawned this was actually me taking an export of all of the inflation that we've been seeing and then comparing that by sorting the year-over-year inflation with everything that's been going up, sorted by highest inflation to lowest inflation. And this is what I got right here. This is the chart. And you can see, we've got gasoline, we got fuel, we got motor oil, we got cars and trucks and kerosene and energy, a lot of things that we kind of expect to go back down over time, right? Like commodities, especially energy commodities, tend to go down over time. Supply shortages in cars, new and used, should subside over time. But I mean, look at some of these things. They're up anywhere between 30% year over year for used cars and trucks, to over 58% for motor oil. It's insane. But then I looked at the rest of this chart and I'm like, man, there's something else going on here. Look at this. What is this? Uncooked beef roast, 26%. Then we have uncooked beef steaks, 24%. Uncooked beef and veal, 24%. Pork, roast, steaks, and ribs, 22.9%. We got lodging thrown in there away from home, but that could be coming out of the midst of the pandemic where everybody lowered prices just to fill vacancies. So I don't really expect that to be much of an issue there. But look at that. Bacon, breakfast sausages, beef, veal, bacon-related products, pork, meats. And so it got me thinking a little bit, what is happening with meat? And I am Meat Kevin, so I figured let's talk about meat. And I did a little bit of research into meat, and together we're kind of looking at this like, wait a minute, maybe there's something sus going on. And if there's something sus going on with meat, is there potentially also something sus going on elsewhere? And what does that tell us about inflation? Let's talk about that in this video. Quick note, this video is brought to you by the programs on building your wealth. Link down below, there is a new Xmas Christmas coupon code that you can use before the price goes up thanks to all this crazy inflation again. Take a look at that coupon code link down below. You get lifetime access and you get to talk to me in our private live chats, see what I'm thinking about the market before I talk about it on the channel, see all of my moves, buy, sell, trades, just so you can see kind of where my head is in the market. Okay, folks, let's look at this. When we started researching meat price inflation, the first thing that we learned is that there were a lot of things that potentially hit supply and demand for meat. And that was during COVID. Production was shut down at many plants. Farmers were left with nowhere to send their beef. So they had to ultimately cull cattle and other livestock, which means killing them without actually being able to use the meat. And farmers scaled back their production at the time. In fact, production for pork fell 6.9%. And so it makes sense. If production goes down, then prices move higher, right? But I mean, 6.7% doesn't really explain 24%, right? Like production down 6%, prices up 20%. That didn't really jive with us. We're like, okay, well, maybe there are other excuses. Okay, there were storms that led to production shutdowns. There are, FUD fears, like worries about Proposition 12 in California, which California is not only the largest state in the country, it is also the largest pork consumer in the entire country. And California has this massive proposition called an animal welfare law that starting in January 2022, pork availability and pork prices might be dramatically affected in California because individual cattle and eggs and hen and pigs and chicken and all this stuff, they have to have enough room to stand and turn around, so it doesn't just affect pork. But a lot of folks are pointing to pork prices potentially going up because of this fear around California's Proposition 12. And so then I got to think to myself, okay, but like, again, fear over California's proposition and maybe temporary production shutdowns for meat, that doesn't make much sense. There has to be something else going on. And so then we found something. Listen to this. A Friday White House economics team report looking at the financial statements of some of the biggest meat processing companies in the country that have somewhere between a 55 to 85% market share of all meat in the country show that gross profits across all of these companies have grown 120% 20%. And their net incomes have gone up by 500%. That's substantial. Now, I didn't really believe that these net incomes and profits have all gone up this high. So I wanted to do a little bit of a trend myself and understand, okay, because, you could kind of play the math game a little bit and go, well, we're comparing that quarter to that quarter, whatever. So I wanted to get a little bit of a longer term trend. So I looked at Tyson Foods financials and I looked at their net margin. So how much they're actually bringing to the bottom line. And when I applied a moving average to the bar chart of their net income, take a look at this, folks. Their net margin in the last 3 years has never been higher, and it is trending up. The line here is the moving average of a trend up of net income at Tyson Foods, one of the nation's biggest food and meat producers. That's a big deal. Take a look at this. This is the simple linear trend line, so to speak. And this is where software tells us the trend line is. You can just apply that. And spreadsheets are a great tool. Master using them. But anyway, this was really simple. I mean, I spit this together in like 3 minutes, these little charts here, because you just take the data, plot it, apply the trend line, and boom, it's like, oh my gosh. Net profits are going up, but wait a minute. They're blaming potential issues in California. They're blaming production shutdowns. But really what's happening is these meat companies are making more money hand over fist, and then they're suggesting that, well, it's Biden's fault or it's Jerome's fault. Yeah, prices are going up. It sucks, doesn't it? But wait a minute. That really got me thinking to myself. If prices for meat are leading companies to be able to raise prices 20, 25%, isn't it also possible that companies like Apple, Nvidia, and basically any company, Enphase, Etsy, Amazon, you name it, anyone selling anything, someone selling courses online, isn't it possible, with a coupon code linked down below, isn't it possible that in theory, anybody could just raise their prices under the guise of inflation because we're seeing inflation, which is kind of us comparing back to the whole of 2020, but then also all of these supply chain constraints, right? That because we have inflation, we're seeing companies raise prices simply to fatten their profit margins, and that the inflation we're seeing right now reported in CPI is really just sort of this potential lingering effect of companies going, hey, we can raise prices, so we are. And now, that's not to say that there isn't actually inflation happening. There is. But when you see production shortages of like 6 to 7% and maybe Prop 12 in California, big deal, and some of these things that might affect the pricing of meat by 10, 12, 13%, but all of a sudden meat is actually up twice as much and profit margins are skyrocketing at the meat companies, you can't help but wonder if maybe some of this inflation is really just an opportunity for companies to take advantage of more profit and building up higher profit margins, passing along more of the costs to consumers than they're actually incurring thanks to labor or production shortages. And all of a sudden, what you end up with is a company like Tyson Meat, which has forward compounded annual growth that in some cases is quite frankly negative, but the growth rate is not that phenomenal for them. I mean, here, take a look at this. This is Barclays' forward estimate. Their revenue is expected to grow at 4.6% on average over the next 4 years, but their net income is actually expected to shrink 4.1% over the next 4 years. So when you start looking at these numbers, it's like, wait a minute. Are these companies just taking advantage of short-term inflationary talk to raise prices, increase their margins, insulate themselves in this crazy market, and that we could actually see margin compression over a lot of these companies that seem like they're doing really well over the next year to 2 years? And really the companies that we're actually going to want to invest in are probably companies that can sustain high margin. That is, what happens if all of a sudden the Tyson food margins start going back down? So these trend lines start rotating back down. Tyson Foods valuation probably going to plummet. I mean, right now it's selling for 10 times 2025 earnings. It's seen as a value play that has turned into a growth play. But if that growth goes away, maybe we could go back to 5 times 2025 earnings, which just feels low, feels almost like a value play. But then again, we're projecting out 4 years, right? Because if you compare it to Google, which is also selling for like a 10 to 12 times 2025 multiple, what would you rather have? Would you rather have Google or Tyson? Well, even if you have margin compression at Google, you're still going to be bringing a crap ton of money to the bottom line, in excess of 20% to the bottom line. You have margin compression at Tyson Foods from 6.5% down to 2.7% again. You're barely making money. And so to me, this is a little bit of a lesson that if companies are being opportunistic about inflation and they're raising prices, the ones whose stocks are probably going to get hurt the most going forward are going to be companies that, when this brief euphoria of inflation and the opportunity to kind of hide under the cloak of inflation, oh yeah, all the costs went up. Meanwhile, they're just raising the prices even though the costs haven't gone up. That's going to go away. And those companies are probably at the biggest risk of, in my opinion, failing. Maybe I shouldn't say failing, but having their valuations compress the most in 2022, 2023, and on. So what are companies that probably can sustain margin or have that fat room? Well, in my opinion, companies that could sustain that margin would be high growth and high margin companies like Apple, Microsoft, Google, Nvidia, AMD, Enphase. These are companies with a lot of room, a lot of margin. Look at Visa, for example. Visa, they take over 40 cents to the bottom line of every dollar of income they make. That's really incredible. So these are things to think about. And I think the two-folded bottom line here, and I'll talk a little bit more about Tyson as well in just a moment, but I think the two-folded bottom line here really is some companies that have done very, very well in 2021 might not do so well going forward because they've kind of hidden under the cloak of inflation to prop their margins up artificially. That's one. And number two, I think when we get compression again, when prices start coming down again and things have to start getting competitive again as inventory starts stacking up, whether it's in new cars or used cars or whatever, or even meat, then we could see prices of some of these things substantially collapse, really hurting margins. And then the companies that win are not going to be companies like Tyson. Now, don't get me wrong. Tyson Food has an $84 price target for December of 2022 by JP Morgan. They believe there's going to be continued and extraordinary strength in industry beef spreads. They actually think that margins will improve in 2022 as processes become more efficient. They believe that 90+% of the Tyson Food staff is vaccinated, and they believe that'll help keep production lines up and running, keeping that efficiency up. At the same time, you've got Barclays suggesting that they're expecting better revenues in chicken and other international segments, both growing at double digits year over year. But they're worried about overall volume potentially leading to underperformance in 2022, but they also still have an $89 price target. So you've got institutions looking at this from the limelight of, hey, well, maybe the growth will keep going. And that's what makes me nervous, is when companies and people believe that, oh, well, the growth is just not going to stop. It's just going to keep going. But if prices do all of a sudden start slowing down, or the growth of prices starts slowing down, because all of a sudden we have much more inventory and there's much more competition between meats again, between cars or other products, I think it's companies like Tyson that are going to get hit the hardest. And that's not try to bag on Tyson. I'm just saying, if you're looking for something to invest in, especially in this dip that we're feeling right now, probably you still want to look for those high margin companies and or high growth companies. That doesn't mean you want to pay a crazy valuation. Hey, take the discount where you can get it. But yeah, margin is going to be critical for 2022. Just my opinion. And this Tyson thing about them hiding the price increases, basically under the guise of inflation while making a ton more money, was an eye-opener to me. That maybe some of this inflation is just being created as an opportunity. Anyway, thank you so much for watching this video. Check out the courses linked down below before that price goes up. Now, in fairness, I know that sounds kind of similar, but in fairness, the prices of my courses, even before we had inflation, always go up because I never want somebody who buys in to think they got a worse deal than somebody who bought 2 or 3 or 4 weeks after them, especially since the content is perpetually expanding. So hopefully I could be seen as different from that, but I understand. Anyway, thank you so much. Check out those programs linked down below in that coupon code. Appreciate y'all, and we'll see you in the next one. Thanks. Bye.